There are so many myths and misconceptions out there as it relates to buying a house. The worst one and most prevalent myth is that you have to put 20% down. This is not true. I can't tell you how many first-time home buyers I talk to who think that you do in fact have to put 20% down because their grandpa said so, and grandpa said, if you don't put 20% down, you have to pay mortgage insurance, and somebody would have to be crazy to pay mortgage insurance. As with most things, there is a grain of truth to this in the sense that if you do put less than 20% down, then yes, mortgage insurance does have to be addressed, but it's certainly not a crazy thing to pay mortgage insurance. In fact, mortgage insurance rates are lower today than they've ever been before. Say there's a young couple looking to buy their first house in Wilmington, North Carolina. The average price point here is $400,000. For this example, we'll say that that's their target. So they find a $400,000 house, they go under contract to buy it, and they only want to put 5% down. So they're gonna borrow $380,000 and make a $20,000 down payment. This is a very, very common conventional loan scenario. Say this couple has good credit, 760 scores. How much do you think they're going to pay a month in mortgage insurance? $100? $200? $300? No, it's not going to be that high. In this scenario, the monthly mortgage insurance only costs $69 per month. They're going to pay $69 per month to keep an additional $60,000 in their pocket to use for other things. And oh, by the way, once you've built enough equity in the house, that $69 a month goes away and you don't have to pay it anymore. On average, they're going to pay that mortgage insurance for the first 4 years of their loan or the first 48 payments. So let's take a look at the numbers a little deeper. Paying $69 over a 48-month period equals $3,312 paid out in mortgage insurance. Again, you're paying out about $3,300 over a 4-year period in order to keep that other $60,000 in your bank account. This can be used as a rainy day fund. It's money that can be used to make renovations around the new house, to buy furniture, to paint. It can cover moving expenses, etc., etc. Let's look at the numbers on a year-over-year basis. We're going to assume that the property is going to appreciate by 3% per year because that's what we can expect in a normal economy and in a typical real estate market. So on day one, when they buy this house, it's worth $400,000, they owe $380,000, therefore they have 5% equity. After making 1 year of payments, that house has appreciated in value by 3%, so it's now worth $412,000. And by making the regular monthly payments, they've paid their mortgage down to about $375,000. $375 divided by $412 is going to give them about 9% equity. After 2 years, the house is worth about $424,000. They now owe $370,000. They have about 13% equity. After 3 years, that house goes up to $437,000 in value. They owe $364,000. They now have almost 17% equity. So we're starting to get really, really close to that magical 20% number. Now, after another year of payments, now it's been 4 years, the house is now worth $450,000 due to natural appreciation, and they only owe $359,000 on their mortgage. That's going to give them over 20% equity, and at that point they can call up their mortgage servicer and have that mortgage insurance removed. But also keep in mind that they've kept $60,000 cash liquid by not making a 20% down payment. Say they invested that money, how much of a return would they need to recoup $3,300 in profit? Well, if we take a look at this financial calculator, it tells us that they only need a 1.35% rate of return over that 4-year period to recoup the mortgage insurance that was spent. So before anybody decides to put down a huge chunk of money on their home purchase, I highly encourage you to sit down with a financial advisor or a financial planner and talk about what they could do with that money and how much they think they can yield by investing it. And oh, by the way, if it weren't for mortgage insurance, then the 30-year fixed mortgage would not exist. See, mortgage insurance is a route for millions of Americans to be first-time homebuyers without having to take on the burden of saving up a 20% down payment. Without mortgage insurance, every mortgage note would be an adjustable rate over a 5, 10, or 15-year period, and homeownership would be even more unaffordable than it is today for Americans. So no, mortgage insurance is not a bad thing. In fact, it's a great thing. It provides the opportunity for many, many Americans to achieve the dream of homeownership who wouldn't have that luxury without mortgage insurance. If after watching this video, you're still adamant about not wanting to pay monthly mortgage insurance, I've got good news. You can actually buy out the mortgage insurance upfront at closing by paying a lump sum. You can even ask the seller to pay for this, or you can have the lender pay for this in the form of lender credits. In this case, the cost to buy out mortgage insurance would be about $3,450 upfront. You never have to address mortgage insurance again. So you do have options. There's lots of ways that the mortgage insurance can be addressed, but just know that it's really, really affordable now to incur mortgage insurance. Guys, if you have any questions about this, you want to find out what your options are, give me a shout. I would love to talk about it with you. My cell phone number is 910-742-6886, or you can email me, Justin@acfsmortgages.com.